All right, so we are buying the XLI Industrial Sector Index.
I like it. I think it's a smart way of playing it. We want exposure where we think we can have the best ride.
Hey guys, JC Parets here, founder of All Star Charts, and welcome to the live stream. I am joined by my esteemed colleague, Mr. Sean McLaughlin. Shawnee, baby.
What's happening?
Putting on some YOLO trades, are we not? Is that not what we're doing?
Stop calling it that. We're not YOLOing.
We're not YOLOing. What are we doing?
We are making a smart hedge against the possibility that perhaps we're underinvested if the market wants to disappoint everybody or surprise everybody and rip higher. No one's pricing that in, JC.
I've been counting slowly. I've been counting the different phone calls that I've been getting, family members coming up to me in Easter. I'm just minding my own business, doing my Easter egg hunts, drinking my Chianti. I'm not bothering anybody. And I got people, asking me about this, JC, what are we going to do about this coming recession that's definitely coming? I'm like, oh, is a recession, because my wife's family, they know what I do and kind of. And, they know that I have something to do with the market. So they're, and then they're asking me about this recession. I'm like, oh yeah, it's definitely coming, huh? Tell me more. So, I was kind of poking and they were just gloom and doom. And then I got some contrarian indicators, historically great contrarian indicator, both buddies and colleagues pinging me offline, telling me that I need to buy as many puts on the S&P 500 as possible. And I'm like, all right, that's interesting. Now I'm looking at consumer confidence in some of the worst or lack of consumer confidence, I should say, that we've ever seen. The only times that you can compare to the present are the great financial crisis, the fiscal cliff, the savings and loans crisis of the early 90s, and the death of equities. That's the only other 4 times you can compare to current sentiment. So I think a lot of negativity is already baked into the cake. Here's the consumer sentiment, as you can see, absolutely atrocious. And when it comes to individuals, say what you want about this poll. I understand it's a small sample size. Everybody has their opinion about the AAII poll, but we have the fewest amount of bulls since 1992, Shawnee baby. And in 1992, such hit singles as Baby Got Back and Achy Breaky Heart were topping the charts last time there were this few bulls in the stock market. Sean,
I was air guitaring to hair metal at that time.
It's a hair metal. I like how hair metal is a type of metal. And then, of course, the Bank of America Fund Manager Survey, how many of them are expecting a stronger economy? The fewest ever are expecting that. So, it seems to me when we go back to other periods, we want to ask ourselves, was that a good time to be accumulating stock, or was this a good time to be distributing and getting rid of stock? Historically, this is a good time to be accumulating. So I think, personally, that there are investors that maybe the risk is that they are not long enough, that there is not enough risk exposure in a portfolio that's outside of tech, by the way. So that's where my head is at.
I got to be honest, JC. I knew anecdotally that sentiment was bad, but until you guys started sharing these charts around the last couple of days, I'm actually pretty surprised by how bearish sentiment is. These extremes are really extreme. Like the fact that if you go back to that other chart, the fact that we've only been here 4 other times previously over the last 40 years, that's epic, man. Epic.
Well, remember, you've got a war, you've got the virus, and then more importantly, half the stocks on the NASDAQ got cut in half. Over 70% of the stocks on the NASDAQ were down 20% off their highs. And now I got people asking me if we're going to go into a new bear market. It's like, what the hell do you call the past year?
Well, I'm not going to sit here and say that the negative sentiment is unjustified. It certainly is. But you know what? It was justified in those previous 4 times. There's always a reason. But boy, those previous 4 times were great times to buy equities. So is this time any different? Let's find out.
So before we get into the actual trade, I want to reiterate 2 things. Number 1, this isn't one of those situations where we're going all in, buy everything, leverage long, flip the book, let's go. This is not that trade. This
No.
is, you want to ask yourself, if we get a face ripper in equities and risk assets, and this sentiment is about to unwind, and you look back at this period, are you going to say, man, I wasn't long enough? Man, I didn't have the right exposure? If the answer to that is, and then do you want to eliminate that risk and take that off the table? In other words, eliminate the risk that we get a ripper and you're not long enough. If you want that risk off the table, we want to put on a trade that is a long shot. That
Right.
chances are it's a zero. But if that happens, you are super, super paid.
Yeah, the important thing here is we're not looking for a trade to bet the farm on. We're looking for a long shot that is probably likely to lose. But if we do get that face ripper that is a risk, quote unquote risk, hey, this trade will participate very well. And that's the
It's
whole
only a
point.
risk if you're not long enough.
Right.
That's a risk.
Right. So we kicked around the idea of, the obvious choices. Should we be buying calls in the SPY or QQQ or IWM, the big indexes? We decided against that. Why don't you get into the thinking on why? It had a lot to do with technology.
Well, if you're buying the S&P, you're getting, half the freaking indexes in tech and growth, right? Right. So is that what you want in this environment? I would say no. And then the NASDAQ is exactly that, but more obnoxious. And then with small caps, you're getting a little cute. What I like, so it was like, okay, maybe financials or industrials could be the bet. And then the thing is with financials, you're kind of pigeonholing yourself to financials.
Right.
Industrials gives you a wide range of different industry groups within industrials. Like, I feel like the index providers, like when there's a company and they can't figure out what sector to put the company in, they just throw it into industrials, right? Like You've got like staffing companies, you got the railroads and truckers, and then you got the logistics companies, and then you got aerospace and defense. Like you've got just like a ton of random stuff all mixed into one. So you have like, it's kind of like a diversified portfolio X tech and growth.
It's the ETF gumbo. Just throw everything in it. It'll be delicious.
And it is. And then this looks, this is the old Schnauzer formation.
Ooh.
Yeah.
By the way, that's 17 years of technical analysis study right there that came up with that Schnauzer.
To be fair, it's a client of ours who's a fund manager, and he coined the NASDAQ a few years ago. The NASDAQ 100 was looking like a Schnauzer, and he coined that. And now when I see Schnauzer formations, I can't help. Needless to say, the Schnauzer formation is a bullish formation. It is a variation of a bullish pennant or a bullish flag or something like that. It's a consolidation within because it looks like a Schnauzer. Tell me this doesn't look like a Schnauzer. It kind of looks like a Schnauzer, right?
Looks like a Schnauzer, sure.
So if we're going to get a face ripper, if we're going to get an unwind in sentiment, I think it's a good way to take advantage of it. And something like this ripping can happen in an environment that S&Ps aren't doing much because they're being dragged down by all that tech and growth.
Right. So let's get into the trade here real quick because I know we're short on time. We wanted to give ourselves time for this to play out. And the options that were available to us, the longest duration options were January of 2023 or the following January of 2024. That one felt a little too far away. So we picked the January 2023 expiration, and we purchased the 130 calls. Now the thinking on that was, in our meeting, we talked that 140 could be a pretty viable price target if we get the face ripper. And the 130 calls at the time that we were talking were trading around 35 cents. Let's just call it 35 cents. So the thinking was, boy, if we buy those at 35 cents and if we get a run to 140, then we have the potential of a 25x return on our investment with those cheap calls. Now, again, they're cheap, and we would size the position such that if we're wrong, and it's a very high likelihood that we could be wrong here, we're going to lose everything. And that's fine. We just want to size the position with that possibility in mind. But if we get it right, we're going to 25x our money or more.
Yeah, likely more, right? Because you're going to have time value as well. 25x our money just on intrinsic value. But when you add that element of time as well, I mean, this could be a 30, 40 bagger. But let's talk about the risk management. The risk management, same thing, same rules apply. If and when the premium in our call options double, so in this case, 66 cents. If it gets 66 cents, you take half off the table. And now you got a free ride until January of next year. And that could be, and then, that helps keep you in the trade because it's a free trade. So psychologically, it helps with the mental capital, not just the dollar and cents capital, but the mental capital too, to stay in it until January, because you've already taken your cost basis off the table. So I'm thinking a few steps ahead, but this is how we want to think through it. And then follow the plan. Like, don't just, it doubled. I'm going to wait for it to triple. No.
Right. Well, I mean, look, the way you expressed it exactly the way I will manage my trade is I will take half off if I get a double. But look, if you're putting this, if you like this trade because you like it as a hedge, there's nothing wrong with just riding it and taking it all the way, not selling half. If that's your goal here, you really are hedging a portfolio that needs that hedge exposure, then there's nothing wrong with letting it ride. But me personally, I'll take half. And, for me, this is a win it or nothing trade. Like I don't have a stop loss level in mind because, again, we're only paying 35 cents for the calls. So it's either going to win or it's not. And that's the way we're looking at it.
All right. So we are buying the XLI Industrial Sector Index. XLI, the 130 calls, January 2023 expiration, 34 cents, taking half off the table on a double. The risk management is already built in because we can't lose more than we invest. So position size accordingly. We like to joke and say this is a lottery ticket or that it's like a YOLO, but it's not that. It really is a hedge against a face ripper and a portfolio not being exposed enough to benefit from such a face ripper and unwind in the current pessimism. And this is a way we put our heads together. I woke up this morning, I'm like, we need a YOLO trade just in case this thing rips and we're not big enough. That's a problem. Let's fix that problem. And this is the solution we came up with. And I think it's a pretty damn good solution, Shawnee.
I like it. I think it's a smart way of playing it. And it's we're not exposing ourselves to the sectors that we don't think will participate if we do get the rally, or, because we're avoiding tech because tech's been a laggard and we like to stick with the winners. So we want exposure where we think we can have the best ride. And XLI seems to be the best option.
Rock and roll, baby. Industrials, let's go. Go get it. YOLO responsibly, guys. And next week, we're going to be doing this live from Washington, D.C. Together, Shawnee. I'm looking forward to that.
We're all going to be in the same room. It's going to be amazing.
It's going to be a total nerd fest. If you're going to D.C. for the CMT Symposium, we'll see you next week. If you don't have plans to go, come hang out with us. See you there.